Speaking of HDFC Life, it's been the quarterly numbers that were declared where there was a margin contraction that dented the Q2 earnings. But what's the road ahead for business? Let's connect with Vibha Padalkar, who's the MD and CEO. Thank you so much for taking time out and joining in. So for the first half, you've registered a sharp growth of 25%, and that's really outpaced the industry. Do you think that you're heading towards this high growth phase again?
At an overall sector level, we reached a new watermark of 11% market share. So our growth, in fact, has been a lot stronger than our own historical growth, as well as, of course, versus the industry.
So can you elaborate a little bit on that in terms of what is the range of the growth that you're targeting for APE and for VNB for FY25?
Yeah, we are looking at overall full year growth of about 18 to 20%. So VNB growth, first half of the year, we have grown about 17.6%. We are hoping to grow in the region of about 15 to 17% on a full year basis.
Right. Vibha, coming to your margins, they've seen a bit of a decline, about 160 basis points. What exactly led to this decline, and is it attributed to the product mix, or you think it's more of a structural shift?
So if you were to look at H1 margins were about 26.2%, and that has gone down to 24.3 odd percent. So this fall that you see, going down from 26.2 to 24.3% for H1. This drop that you see is about 30 basis points is due to repricing. So on our non-par portfolio, we decided not to reprice because there was a rush to be compliant on all our other product portfolio, about 40 products that we had to get past the deadline as of 1st of October. And hence we decided that some of our products that were going to be phased out, we will not reprice those products. So that impact was about 30 odd basis points, and about 130 basis points impact that we saw is due to product mix. And I've talked about this in the past, that equity markets are elevated, whether you're looking at mutual funds, whether you're looking at direct equity play, or whether you're looking at unit linked. And not surprisingly, H1 of last year, unit linked was about 28%, and that has gone up to about 36% in H1. Although quarter two was a little bit lower at about 34%, but nevertheless, it remains the flavor of the season, and hence the impact on margins. Just to articulate and reinforce our strategy, just given the shifting sands that we're seeing in terms of the macroeconomic environment, we are focusing on new business growth. That is number one priority. We are also focusing on VNB growth, and like I've articulated, in the range of 15 to 17%, and we are on the upper end over there. And margin will be an outcome. At the same time, margin will have a floor. So it's not that margins will be in a free fall. There will be a floor, but there will be some level of softness in margins, given that we want to drive the first two objectives.
Right, and with the higher competitive intensity, how are you planning to keep your VNB growth intact? How are you planning to protect margins? Will there be any change in pricing?
On the change in prices, we don't expect any changes in prices due to surrender regulations. We do change our prices periodically on non-par products based on what is the interest rate regime and what are we earning on the assets. But not due to the surrender regulation. That's number one. On segments such as protection, we do dynamically reprice upwards or downwards based on what is the mortality experience that we are witnessing. Annuity is the same based on interest rate environment, and we do dynamically reprice our annuity. So this is fairly business as usual, nothing to do with anything that is pegged to the change in surrender guidelines. As far as ring fencing the value of new business, many things that we do on an ongoing basis. Number one is product mix, wherein we will remain range bound. Although unit linked is currently elevated, but it's not in the region of upwards of 50%. That is not uncommon to see in our sector. So we will keep it range bound. We will also do dynamic repricing, like I mentioned. So rigor in terms of, and rigor and discipline in terms of product pricing, like in anything that you do, that is important. Third aspect is control on costs so that our cost of acquisition continues to again be range bound. And fourth aspect is in terms of product innovation, and that as we innovate and keep coming up, we're known as a product factory. As we keep launching new products and blockbuster products, we do tend to garner a certain level of business because we're launching a product that did not exist before. And that also helps us in terms of accretion to value of new business.
Right. Vibha, earlier you mentioned that you're eyeing to double the VNB every 4 years. Does this still hold? And in order to grow, do you think there's a downside risk for VNB margins?
No, I think in terms of a 4-year horizon that I talk, 4 or 4.5 year horizon in terms of doubling, I think we should still be there because, there are cycles that one goes through in terms of the equity cycle or a more bearish cycle, and it tends to even out. Our experience over the past decade is that it tends to even out. What is very, very important is that we have enough attractive product proposition in every segment, as well as our salespeople are truly and deeply conversant with all products, so that as we come out of one cycle and move into another cycle, it is seamless, there is no disruption, and we are able to switch. I think these are the aspects that are important. And time and again, given that in any cohort of 4 years, we have close to double our VNB, that just gives us the confidence of being able to do that.
And with the new norms around surrender charges, you quantify the impact will be about 100 basis points. Can you reiterate your stance, or do you think that there will be perhaps a lesser impact?
We will be doing, as we speak, we are in conversations, and we will be able to minimize the impact. It's just that over the next quarter, there will be some levels of discussions that will be ongoing. But beyond a quarter, as we get into Q4, we should have a lot more clarity as things settle down.
At a distribution channel, you added 80% new agents from Tier 2 and Tier 3. Are you looking to penetrate such markets with more channel agents? Will this add more pressure on margins?
So we've never really deployed a strategy that is not sustainable, whether to give disproportionate level of commissions or to give a much higher level of IRR than what you're earning from the underlying assets, and so on. It's always a calibrated strategy. In fact, what we are hearing now is that post the surrender charge regulations, there has been some of the large players are talking about reduction in margins. And that's something that we would welcome because it needs to be calibrated. We will continue with our strategy on Tier 2 and 3. Tier 2 and 3 is contributing about 2/3 in terms of APE to our overall new business APE, and we remain very gung-ho. So the number of agents that we add, most of them are in Tier 2 and 3. Most of the branches of our 600 branches, and out of them, the new branches that we're adding would be, the focus will be in Tier 2 and 3. These are large areas that are relatively wide spaces for us to sensibly reach out and build business over there. And one of the big channels, important channels, is our agency channel.
We have already seen the VBN margins falling, but growth for the business has remained strong. How do you see these numbers, and what should investors expect from the business?
Given that we are in a buoyant equity situation, we have strategized this as follows. Number one, growth is important, and hence, as demonstrated in H1, wherein we comfortably grew faster than the sector by about 400 basis points, the private sector, both in Q1 and Q2, that will continue. Number two is that the value of new business will grow. I've said before, at about 15 to 17% growth, and we have demonstrated about 17.4% growth in H1. That will also continue. Reason that will continue is that is what will add to our embedded value and will over a period of time unwind to cash. So these will become real profits. So it is important that the quantum of profits is something that we don't say no to because we are tethered to a new business margin. Third will be the new business margin, which will be an outcome. At the same time, I'm not saying that it will be in a free fall situation. There will be a floor to new business margin, but maybe 100, 200 basis points or in that kind of a range. As long as we are growing on value of new business, that's going to be the focus. Last point I want to mention is a very interesting factoid, and that is of the new customers that, or rather of the customers that came were onboarded in H1, 70+% were new to HDFC Life. Now, if we say no to them just because I'm tethered to a particular margin, then those customers are going to go elsewhere. So customer acquisition as a strategy so that down the line I can upsell and cross-sell to those customers also is equally important. So to summarize, top line growth followed by value of new business growth and then new business margins.
Right. Vibha, so good having you on the show. Thank you so much for taking the time out and speaking with us about your quarterly numbers and, of course, the outlook going forward.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.
Hyundai Motor India Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of Rs 1,865 to Rs 1,960 per equity share of face value of Rs 10 each. The anchor investor offer period opens and closes on Monday, October 14th, 2024. Offer opens on Tuesday, October 15th, 2024. Offer closes on Thursday, October 17th, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, SEBI, BRLMs and the stock exchanges.